our inflationary price target, which is $8,900. Now, 8,900 still sounds very, very high, but that's actually from here until 2030. That's a 14.5% CAGR, which is below the 19.7% CAGR that we realized when this golden decade began. So I think we're still right on track for this 8,900 target. But again, Jeremy, we can come up with all sorts of different price targets.
Yeah.
But I think you have to ask yourself the question, is this a normal gold cycle or is it really a remonetization cycle? And if you say it's a remonetization cycle of gold where gold really gains monetary importance on a global level, then I think that gold is still dirt cheap.
Gold is no longer behaving like a normal cyclical asset. The deeper argument now is that gold is entering a remonetization phase in which it slowly regains importance on central bank balance sheets, in sovereign reserves, and in private portfolios. Ronald-Peter Stöferle, a respected monetary analyst and co-author of the In Gold We Trust report, argues that the long-term inflationary target for gold remains around $8,900 by 2030. Weak seasonality, stronger economic data, and a major shift in rate expectations have put pressure on the market, and it may still want to test the round $4,000 level. But in his view, that kind of weakness should not be confused with the end of the bull market. It looks more like base camp before the next climb. If gold is being remonetized globally, then even today's price may still be low. Now, we present the clips from his interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think we are getting closer and closer to some sort of a panic level. And I think that, to be honest, and we wrote that in the In Gold We Trust report, we shouldn't expect too much for gold for the next couple of weeks. We've got weak seasonality. We've got the big U-turn when it comes to interest rate expectations. So basically, we went from 1 or 2 rate cuts this year to 1, perhaps even 2 rate hikes this year, and up to 3 rate hikes until 2027. So this has been a huge U-turn when it comes to interest rate expectations. But I think, there's lots of reasons that we can discuss, Jeremy. There's obviously the job numbers that came out much stronger. We've seen the ISM and the City Surprise Index with positive surprises. We can talk about the capital cycle that is kind of flipping, not only all those huge IPOs now, also, Gulf sovereign funds. They have to fund pipelines and infrastructure. OECD's ramping up defense spending. So basically, all of it competes for capital. But I think, if we want to draw an analogy, I think the best is if we compare it, to climbing a mountain, climbing Mount Everest, which is almost 8,900 meters high, which is almost exactly our long-term price target. I mean, you cannot just run up the Everest. At some point, you have to stop, go to the base camp, rest there for a couple of days, get used to the altitude, get used to the thin air, and then, you can continue climbing. And I think, people tend to forget gold had a return of more than 60% in dollar terms last year. I mean, for a pretty big asset class like gold, that's a huge return. And I think now we really have to digest this move. We're sitting now in some sort of a base camp. Of course, I mean, bull markets are more fun than bear markets, but I think, we're already seeing pretty negative sentiment. We're seeing, when it comes to the mining stocks, we're seeing almost some panic, but a bottom is a process. So I think, lots of damage has been done technically. And I think the market usually wants to see like the round number. So I think that we will test the $4,000. But I think, you really want to be aggressive buyer at those levels. It's not going to happen. I think we're more seeing some sort of a silent remonetization of gold. And, there's a couple of the obvious ones, obviously, central banks buying like crazy. We had 3 years in a row, central banks buying more than 1,000 tons. Now, last year, everybody was disappointed because central bank gold demand was only 860 tons. But due to the rise in gold, that was in absolute terms, that was a new all-time high. First quarter of this year, more than 250 tons again. So I think this will continue because emerging market gold allocation is still significantly lower than the gold allocation of Western countries. Now, obviously, it started in 2022 with the sanction against Russia, and I think that's, you can compare it to traveling somewhere abroad. You only have one credit card. If you lose it, if it gets stolen, if it doesn't work anymore, you need a plan B. And I think that gold is this monetary plan B for central banks, especially central banks in emerging markets. Mm-hmm. Then the second point is this private remonetization that we talked about previously. So family offices, pension funds, high net worth individuals that are slowly now discovering gold as a strategic monetary asset again. So this will go hand in hand with more turmoil in fixed income. Then I think one factor that is sort of misunderstood is this balance sheet management. We're seeing a silent recapitalization of central bank balance sheets. Mm-hmm. Now we've seen it in Germany, where they basically one representative of the Bundesbank said, well, actually you can treat those 360 billion that we've got basically in profits from the surge in gold from our gold reserves. We can basically treat that as some sort of equity in the whole euro system. That's more than 1.2 trillion that this surge in gold prices actually helped the balance sheet. And then the big question is obviously if there's going to be a remonetize or a revaluation of US gold holdings. We all know still, they've got it at $42 in their books. If they would revalue to current prices, well, that's more than 1.1 trillion just from the revaluation to current prices. So I think that's becoming more and more important. And I think that's perhaps it's a slightly nerdy topic, but for central banks, actually, they're super happy that the price of gold is rising because it makes their balance sheets stronger. Mm-hmm. And then you've got this digitization and tokenization. Well, we've got a big chapter on Tether in the Gold Report and an exclusive interview with Juan Sartori, who is the head of special projects at Tether. Tether is basically building a new, like a parallel universe. And, they're already holding almost 200 tons of gold. They're very aggressive. They told me that in some month last year, they were the second largest gold buyer worldwide. They're storing everything in their gold vaults in Switzerland, deep in the Swiss Alps. So I think this is another very, very important driver that they're bringing gold into the 21st century. And then perhaps some sort of a wild card, perhaps at some point the West could start buying again. And we say that those, what we call the gold light countries, perhaps at some point they will start buying gold again. Canadian central bank doesn't hold too much gold, unfortunately, but there's lots of gold being produced in Canada, lots of gold in the ground. Perhaps they will say, well, actually, if you're mining gold in Canada, you have to offer it to the central bank. There are other gold light countries like Australia, but also Japan, the UK, perhaps at some point to reestablish trust in their currencies, into their bond market, they will start buying gold again. So those are those six factors and drivers of remonetization. It's a really big chapter in the report. And again, they're to some degree independent from each other, but then they strengthen themselves. So I think that with reading the reports that I'm reading, following what's going on in geopolitics, for us it's pretty clear that gold is in such a remonetization cycle.
The most important shift is no longer coming from Wall Street. Western ETF investors may panic during pullbacks, but the physical demand center has moved east toward China, India, Dubai, and other emerging markets. Central banks have already bought huge volumes of gold for several years, and even when tonnage slowed, the dollar value reached record levels because gold itself was higher. After Russia's reserves were frozen in 2022, many countries realized they needed a monetary plan B. Gold became that plan B. Private investors, family offices, pension funds, and high net worth capital are also slowly rediscovering gold as a strategic reserve asset. At the same time, stronger gold prices are quietly improving central bank balance sheets, making gold a tool of financial repair, not just protection. Let's get back to the interview.
March, 86 tons of outflows from gold ETFs, so real panic from Western gold investors. But then on the other hand, we saw big purchases by Asian ETF buyers and also pretty solid demand by physical buyers in emerging markets. So I think that with the data from China, we all know that China owns significantly more gold than they officially publish. We all know that China basically, since the Shanghai Gold Exchange was started, imported, I think, what was it, 28,000 tons of gold. That's a big number. We know that. We quote an analyst in the report saying that the Indian housewife is actually the smartest hedge fund manager because they're buying gold. They're buying every gold dip. So I think, again, if we zoom out, and we can discuss weekly fluctuations, but I think it's kind of useless. If we zoom out, it's crystal clear, with China and India being responsible for more than 50% of physical demand, it's crystal clear that Western investors don't influence the gold market that much anymore. So the center of the gold world clearly has moved from the West to emerging markets. And I think it has always been like that. Gold always went where prosperity is, where the real growth is, where you're seeing high savings rates. So just travel to Shanghai, to Mumbai, to Dubai, although perhaps at the moment it's perhaps a bit risky, but you can really see that gold has a completely different importance and significance for people there, and that's not only retail demand but also institutional investors. So I stick to my long-term thesis that we laid out in the New Gold Playbook. Focus more on the demand from the long-term demand from emerging markets and less on what's going on Wall Street. I think it's, if you want to trade balance, let gold go. So as Luke said, gold has been the arbiter for 5,000 years, and I think that what you showed in this tweet, that was just the imports. But let's not forget that China is for many years now the largest gold producer, and not 1 ounce of gold actually leaves China at the moment. So I know that those numbers that Luke's suggesting, like in the $20,000 level, whatever, that sounds like crazy for most people. However, we did a couple of similar calculations in the report. For example, the shadow gold price. So if we would actually back the monetary base with gold again, we would easily be above 20,000 US dollars. And that's just for the US. If we do that on an international basis, we would go to significantly higher levels. So I think, and that's really the fascinating thing. And we have, by the way, we've got a great interview with Luke Roman and also Craig Tyndale, who's very, very knowledgeable when it comes to commodity flows in this year's report. But I think, Jeremy, what's so fascinating is previously politicians, they never talked about gold. They couldn't care less about gold. Now Donald Trump comes in, and his first words as a president was "Welcome to the golden age." Now I don't know if that was really about our gold, or it's just like, to kick off his speech. But then there's people like Scott Bessent saying that, he wants to be a part of a Bretton Woods realignment. Scott Bessent saying that his largest gold position, his largest private investment is actually gold. Dr. Judy Shelton, we also did an interview with her. She said she knows Scott Bessent very, very well. and Scott Bessent knows everything about history and about monetary history. Then you've got the fact that Kevin Walsh, Scott Bessent, and also Stan Druckenmiller were trading alongside. And I think those gentlemen, they really understand gold. So I think that Trump is quite vocal. I mean, he, talking about interest rates briefly, he said last week, I think, that U.S. interest rates should be below 1%. So he's putting some pressure on Kevin Walsh, obviously. But Trump was also quite vocal, saying that the US dollar is overvalued, and that he wants, obviously, this reindustrialization or this renaissance of US manufacturing. Now, obviously, he wants and he needs a weaker US dollar. And I don't know what Trump and Xi Jinping talked about at their summit. It seemed that from a if you listen to diplomatic analysts and political analysts, well, actually, it was kind of a no event, and most people said that Xi Jinping actually showed how powerful China nowadays is, and that was, I think, there were a couple of smaller details that clearly showed that China is regarding themselves in a better position than the US. And I think that gold definitely plays a role in that. Now, if they should really balance the trade surplus against its gold imports, yes, we can talk about 26,000 US dollars, about those price levels. The big question for me is if it's really, if this also kind of explains the dollar's pretty odd behavior recently. So it hasn't really spiked during the Iran war, but it also hasn't really collapsed. In fact, quite recently, it showed some strength again. So that's kind of the big question that I have. If this really, if the development of the US dollar is basically confirming that story that Luke is talking about.
The larger predictions become even more dramatic when viewed through the lens of balance sheet repair and global monetary realignment. If the United States revalued its official gold from the old $42 book value to current market prices, it would create more than $1 trillion in balance sheet value. If gold were used to back the monetary base again, the implied shadow gold price could move above $20,000. And under some trade balancing scenarios, levels near $26,000 are even discussed. That does not mean gold moves there in a straight line. The market can pause, correct, and frustrate investors for weeks or months, but the larger trend is being driven by forces bigger than ordinary speculation: central bank accumulation, emerging market savings, de-dollarization, tokenized gold, and the possibility that Western governments may eventually buy again to rebuild confidence. The message is calm but powerful. Gold may not just be rising because investors are afraid, it may be rising because the global monetary system is slowly admitting that it needs gold again. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.